In today's video, I'll be looking at strategies to minimize taxes when you've saved $2.1 million in pre-tax accounts such as 401ks and IRAs, and you're planning to retire at age 62. If you're new to the channel, hi, I'm Rosanna Quinnan, a chartered financial analyst and founder of Greenvest. And after working with hundreds of retirees with substantial pre-tax savings, I can tell you this, the tax bill is often one of the biggest shocks you face in retirement. That's why I've developed specific strategies to reduce taxes while minimizing the income you actually get to keep. And that's exactly why I'm making this video today, to show you how this tax problem builds, why so many people miss it, and the most effective ways to minimize taxes on your pre-tax accounts if you're planning to retire early around age 62. So let's dive in. Most people assume their tax rate will drop in retirement because their salary goes away. But for retirees with large pre-tax balances, the opposite is often true. Taxes can stay the same or even go higher once withdrawals and RMDs begin. And most people don't fully believe this until they see their lifetime numbers on a screen. That's exactly the moment my clients David and Susan found themselves in. Now, before I share the actual case on the screen, let me quickly explain why pre-tax accounts quietly create such a large tax exposure for so many retirees. Imagine someone who saved $1,000 a month for 20 years into a 401k and invested that amount in stocks. That's $240,000 of contributions, with market growth that can easily turn into $800,000 or more by retirement. And here is what most people don't fully feel while they're saving. Every single dollar is taxed as ordinary income when it comes out. So if that retiree is roughly in a 24-25% tax range, that's over $200,000 gone to taxes over time, just from that one account. Also, here's the twist that catches people off guard. You're not required to touch that money until you're age 73 or 75, depending on the year you were born. And if you let it keep growing untouched for years, many people are shocked by how large their first RMD is and how much taxable income it suddenly creates in 1 year. And remember, pre-tax money is not taxed at capital gains rates. It's taxed at your personal income tax rate based on everything stacked on your return: Social Security, RMDs, pensions, investment income. And once your income crosses certain lines, there is another layer of cost most people don't see coming: Medicare IRA surcharges. This is why retirement tax planning isn't just about paying taxes. It's about managing how your income shows up so it doesn't quietly trigger higher tax brackets, higher Social Security taxation, and higher Medicare premiums all at once. And this exact dynamic is what David and Susan were walking straight into. Now let me show you their actual plan on the screen so you can see it for yourself. What we are looking at here is the financial family blueprint in my planning software, Right Capital. And we're looking at David and Susan's picture. David is 60, Susan is 58. They live in Massachusetts, and they've had very successful careers in finance and biotech. They have 2 adult children, Robert, who is 30, and Ashley, who is 28. They too have successful careers with their college fully paid off by their parents. David and Susan have done a great job saving. They've saved about $2.1 million in pre-tax accounts. David has 2 accounts, a 401k and an IRA, worth about $1.2 million. And Susan has a 401k with about $852,000. Additionally, Susan received an inheritance worth about $300,000 from her aunt. And because of this inheritance, she also received a step up in the cost basis, meaning that when she withdrew money from this account, she wouldn't incur a ton of capital gains taxes. David and Susan own a joint bank account with $57,000, and they also own a home worth $975,000 with $40,000 left on their mortgage, which they plan to pay off completely when they retire. So having crossed this $2 million threshold, David and Susan were wondering, what if we retire a couple years earlier and don't wait until 65? Can we do that successfully? Now, David and Susan are about $9,500 per month budget, and they thought that once they retire, their expenses would drop to about $7,500 a month. So with that, we decided to look at their plan as is and see what that picture would look like. And indeed, David and Susan have about 96% a chance of having a successful plan, meaning they only have a 4% chance of running out of money, which is not that likely. Look at their cash flows in more detail to see how this plays out in reality. So you can see the year that we're looking at, the next year, they both are making pretty good income and they're paying a hefty amount in taxes. They're still planning to save in their 401ks until they retire. And you can see that their expenses in this year are high because they do plan to pay off their mortgage completely before they retire. So once David retires and then Susan retires, they have several years where they don't draw any income and their taxes drop quite a bit. And they're withdrawing from their bank account and their brokerage account to pay for their living expenses. Then as they reach 70, their Social Security kicks in. And finally, by the time they are 73, they just need to start taking required minimum distributions from their 401k and IRA accounts. And here is where things start to change. You can see very clearly that their income actually is quite substantial. It starts with about $176,000 per year, and it grows all the way to about $530,000 a year by the time they're in their 80s. And with that comes a really hefty tax payment. Now their tax payments are in six figures. And that's something that surprised David and Susan very much. And they had never been worried about taxes until they saw this. And their question to me was, well, what can we do about it? And with that, we looked at a tax strategy to see if we could reduce that tax bill. And the first thing we did was looked at a Roth conversion strategy. So right now, they do not have a Roth IRA account, and they weren't thinking about converting their pre-retirement balances into a Roth IRA because they didn't know they had a substantial tax issue. So now that they knew about the taxes, we said, what if we convert the pre-tax amounts into a Roth amount, and we start at a 12% window. So we fill in their tax bucket up to 12%. And we looked at the results. And you can see the impact of just that one action on David and Susan's financial picture. Over their lifespan, which incidentally will be 95 years of life expectancy for Susan and 92 for David, they would have saved about $1.8 million in taxes. And not only that, the Roth conversion would result in $3.1 million more of tax-adjusted ending assets and, shockingly, about $4 million less withdrawals from the tax-deferred accounts. So as you can see, this is a very powerful strategy for David and Susan. Not only that, but we looked at the terminal tax rate for them. And what is the terminal tax rate? Here, we're taking into account the tax rate that their kids would be subject to when they received the inheritance from David and Susan. One of David and Susan's goals was to leave substantial assets for their kids. But when their kids would be receiving these amounts, they would be at their peak earning years. And if we assume that their tax rate would be at 24%, what we want to make sure that when they received that inherited IRA and they need to distribute that money in about 10 years, having a Roth account would in fact help their kids, Robert and Ashley, in their own tax accounts so that they don't receive a financial headache rather than inheritance. So we also want to look is the effect of this withdrawal on their plan. If we go to the proposed plan and we look at the details of this plan, and if we go into their Medicare premium tax bracket, we can also see that this conversion helped David and Susan with their Medicare premiums quite a bit. So you can see with their modified adjusted gross income with conversion, they do not have IRA for quite a bit until they get about 80s when their Medicare premiums start going up because their income goes up as well. While we look at their premiums without the conversion, you can see that they hit these thresholds way much earlier in retirement when they're in their 75, 76 versus closer to their 80s. Last but not least, I'd like to take a look at a few other comparisons. Here we can look at their investment assets and see that the Roth conversion resulted in about $2.2 million more in ending assets and $3.1 million more in tax-adjusted ending assets. Similarly, if you look at their withdrawals, the Roth conversion results in fewer withdrawals from their accounts. And last but not least, if you look at their balances, you can see with the Roth conversion, you have built a nice tax-free assets for their kids that by the time they inherit it, it's worth $11.4 million. One thing I'd like to mention here is that you need to have a Roth IRA account 5 years before you start withdrawing qualified distributions from it. In our case, it may not play out this way, and David and Susan may not even need that account, but that's something to know. So if you're considering a Roth conversion strategy, you should open a Roth account right away. And another thing to consider is that you cannot convert your RMDs, your required minimum distributions. So in order for you to do a Roth conversion, you need to have specific amounts dedicated to Roth conversion and also take out your required minimum distributions when they're due. With the Roth strategy, the Whites' tax-adjusted ending wealth increased by over $3 million. Their children inherited a tax-free asset. Medicare premiums stayed lower for much longer, and higher tax brackets were delayed. And their tax picture became much more predictable. Not only that, but even after Roth conversions, they still had positive net cash flow, which opened the door for gifting to their kids much earlier in life, qualified charitable distributions, and even donor-advised fund planning. This is why Roth conversion planning can be one of the most powerful tax strategies in retirement when it's done in the right window and for the right reasons. Now, Roth conversions are one way to reduce taxes, but they're only one part of a bigger picture, and that picture is in your income plan. Because whether it's taxes, withdrawals, or investment decisions, the real question is, how much income do you actually need from your portfolio and how long will it last? That's why I created a free video that breaks this down clearly, how to calculate your required income in retirement and your safe withdrawal rate based on your specific situation. If you want to understand how your retirement savings can translate into income and how taxes, market risk, and spending all connect, just click the link below and fill out a few quick questions. I'll send you the video right to your inbox within 48 hours. I'll see you in the next video.